so obviously there's lots of different trading styles.
Mm.
Do you believe that certain trading styles are suited for different people?
Yeah,
or
like
you
in
feel
superiority.
like they can all be adapted to?
Oh yeah, that's a good one. Yeah, trading styles they're all adaptable because they're only made up of the same kind of stuff. It's just, where does your brain hyper fixate? You know, that's where we end up like trying to get entries, or we try to get exits. These are areas where we look at them and for some reason we say, dang, like I think the market's gonna do something around here, you know? So depending on your trading style, you'd be looking for certain things on the market to be made, but depending on how that market went about that level, it's still gonna pick an up or down direction anyway. So did you get your entry model or the things that you normally look for in order to press the button, you know, with the right risk parameters? I think that's the biggest aspect. So if I were to rephrase my answer, I think trading styles are all risk management based more than they are about like superiority or per person. Yeah, so if you have a trend trading style, or if you have a reversal trading style, which would normally be like reversal trading style, and then you have maybe a scalping trading style, which would more likely be just quick impulses. Maybe we'll say that's like minesweepy type.
Or just like fast?
Yeah, super fast. Yeah, so you get all these like intricacy, like structure levels in scalping, and then you get your like swing trades and long holds and stuff. So I would call that more of the like one of those little head and shoulder boys. So risk base is like understanding the space from your entry. So this is what kind of changed my brain, to be honest. Yeah, so linear and circular. I like circular over linear, and I'll show you why. So when you think linear, your entry is always linear. This is your entry. And if that's your entry, based off of a trend, your stop loss has to go here. Right? It doesn't necessarily move with you unless the trend is stacking higher. So you'd only be able to bring this to break even after you get this guy, like the next touch in the trend. Whereas in a reversal, for example, maybe you get a break and this retest, here's your entry. You just don't want it to break the lowest point because it still needs to hold this. This is linear as well. In scalping, you still have a very linear experience because if you were to take a structured level, this would be it, this would be your stop loss, and then with these linear perspectives, your stop loss gets bigger the higher it goes. All right. Right, so this becomes the area that you end up exposing yourself to because this is the technical you're choosing to follow. So if this makes sense, this area at one point was really small. But now as you go in profit, we have this psychological way of thinking where we say, well, my account when I entered this position was at $1,000, so I'm up $1,000 at the moment, so I can bring my stop loss to break even. But since you never close the position, you don't add that to your account value. But I mean, you're up $1,000, you know what I mean? You're still up, so you could turn this into a second trade. But there's the fear of not wanting to do whatever, right? but this is still going up. Most people, instead of adjusting their stop loss according to the actual technical, they only think from the area of entry. So then they will put their stop loss on the entry. But really, your stop loss is here, right? So when that trend comes back down and breaks this, you're supposed to be out of the trade here, technically. Your trade is done. This should be a whole different trade. But most people would hold it, and then you end up in a pretty bad space of psychology. Same thing with the scalping perspective. This retest, if this didn't hold, this would have been us stopped out. But most people would see this hold, and then they would keep their stop loss at break even instead of moving up, right? Same thing here with our reversal. These, probably the best stop losses you ever get, to be honest, but they still do have their chance of like coming back down. So you do expose yourself to more risk, even though these are less probable of getting stopped out when you do get the bottom of the market, but you never know when you do. And then on a circular note, I didn't mean for this to be circular, but we're gonna treat it like a circle. So this could be similar to a reversal trade, but on a circular note, when we take the lows, instead of making trend lines, right, because now trend lines will allow us to get an entry here, and we don't want to see it break the trend line. But now the trend line is going lower every time. So in order for this trend line to break, this still could end up going negative and still follow your trading plan, you know, because it's still bouncing on this trend line. So this trend line gets deeper and more money that you would have to end up taking, right, on the risk management side. So if we think circular instead, this allows for a way better risk management plan. So I'll show you what circular looks like. So for me, when I look at the market, the reason why the domes are like a really good thing is you get the drops, you get what usually would be a trend line, right? But when you do a dome, instead of having this trend line go straight down, you would just bend it inside, right? It's going to trail upwards. So now these, instead of being a straight trend line, these now curve in, which gives you sweeps and retests, and it gives you a parameter that continues to trail. So that way you know if this ever breaks or this ever breaks, this momentum could be gone. So now your stop loss isn't necessarily going more exposure. Now this is your entry, this was your stop loss, but now your stop loss is trailing with you, right? So now this area is how you trail your stop loss, and now you don't have to experience a negative based off of the same technical you choose to take your trade on. So here, this is your trade, your technical follows to go up. Here, you take your trade, your technical just creates this cup and a base, which says, okay, this, no candles allowed to close under here, you'll never be able to go red on this trade. If you get a trend breakout, that's easy spill off. Those really break out fast. You get a really big dumps. When you do reversal trades and you're trying to hold for the highest high, most of the time your brain is stuck on where my take profit is and how much money that might be. So you're willing to risk all of this area. And most of the times, if you're not a trader who usually holds for 15 minutes towards an hour, you don't really get to experience a lot of that profit. So the main driving point here is based off of how you think your stop loss would be exposed more to more risk in general. So in a linear mindset, you will get the most negative experience. Whereas a circular mindset, you might lose more trades, but the lose isn't necessarily a loss. I say lose because you get stopped out, but you're getting stopped out in profit, you know, which you didn't get your highest take profit, but you're protecting your account for risk management. So when you're trading a funded account, you put yourself in a position of actually keeping the money in the account, which goes back to our idea of account balance, right? At least it's always gradual to a degree. And then we have our style to understand when it's time to use a linear mindset, whether you use linear for entries, and then a circular mindset for risk to reward. But yeah, so the original question that you asked was like, is there a certain brain that you have to use certain strategies and things like this? Genuinely speaking, it's just a formula that makes the most sense for what kind of account you're managing, and what amount of time you have in your day and attention that you're giving this thing, So I think that's where I've been putting it as a mentor, to where it's like, if I can focus on just an hour a day, that's the bare minimum for most people. So if I could show you how to do it within an hour, then you can scale that to your session, whether it's 4 hours or not. The longer your session, the more dynamic your strategy needs to be. The shorter your session, the more impulsive it needs to be, because you just need to get in, take that one trade, get out, and that's it. So if it doesn't look the way it looks, it's got to go. But if you're going to spend 2 to 3 hours on here, you get time to watch too much data, too much flow, and if you're not properly articulating it, you don't give yourself a bias. You're just trying to trade the scalping intricacy instead of being able to trade like a bigger reversal or trend vision, if that makes sense. Yeah?
Yeah, that's fun.
Yeah, so it's really weird, but when you start getting trading experience, it really comes to life, Yeah. But this is like my analytical perspective on it, and for me, I've realized I've been all of these guys, and it's not that one is preferred over the other, but it's taking a dynamic approach of understanding when you should do what. Linear, really dope for entry purposes. I think this wins every time, because this is where you get levels from, like supports, resistances, fair value gaps are linear, latent liquidity or high and low of the day. All of these are lines you draw across. These are linear. But when you approach linear, right, you want it to also flow, right? So flow is going to be the order flow. So when we say flow, it's like, if this is a level, I'm going to get rid of this. Is good? No questions on this stuff?
No, I think that is amazing because it adds a lot of context to the circle and really the strategy behind it and the risk to reward advantages of it.
Hell yeah. Yeah, that's what I'm trying to do, bro. I think it's crazy. Like,
I know, it seems like ultra common sense to be like, oh yeah, your stops are lower, but to actually get the signs,
the metric behind it.
Metric behind it and why it works so well, it just adds extra knowledge.
Facts. I think the common sense thing is really funny when you say it, because a lot of the stuff is common sense if you really looked at it with hindsight, but the real war is, what do you follow in your psychology in the moment, not to take this on a whole philosophical experience, but to keep it super short. Anytime in your life when you have a very big decision in front of you, it requires deeper thought than just your normal routine, because it's not a part of your normal routine, So whenever you're looking at a trade that looks familiar, it's kind of the same situation where it's not necessarily part of your day-to-day, but whatever you decide right now could really determine how the rest of your day is going to go, tremendously. And that's genuinely how most of our positions are going to be, So just giving it that much power in our mind psychologically causes an inherent amount of stress, And if we don't have an analytical way of approaching it, no one necessarily likes that much risk unless you genuinely don't care because you have nothing to lose, right? So when you're trading a funded account, again, if you have nothing to lose, it's only $50, it's only $100. You have some students who will just blow the account. Some of them are going to make 10 grand, but they're also going to lose 10 accounts on the way of making 10 grand, right? That's the guy who, okay, I got nothing to lose anyway, so I'll just do it, Then you have other guys who, to a degree, they only have, let's say, $1,000 left. They can't really lose this money because they need at least one of these $100 to work. So now every loss feels super limiting. So they hold on to their account, trying to make hundreds of dollars a day to just get funded, and the journey becomes super long because you're not necessarily having a system. So both of these areas are not wrong or right, but you're not understanding the true equation here. It has nothing to do with how much you have or how little you have, right? It has everything to do of your analytical approach of how do you put yourself in the best position possible to take advantage of the situation. So with funded trading, at least we took off the aspect of, hey, you don't have to use your own capital. But now we can't just use that and build up a lot of debt through multiple accounts. You know, we still want to take the analytical approach to squeeze out, how can I turn this $100 into $1,000? You know, that's 1,000% gain. You literally can't do that unless you're doing crypto pump games or options trading, you know. So, okay. So this flow is what we'll talk about. So on a flow state, right? When you have a chart, you always have your daily highs and your daily lows, right? So I'll just draw like a really big run, and then I'll give us like one of these. So that's like the chart we're looking at right now. So this is our lowest point of contact. This is our highest point of contact. All right, these points of contact are linear. Right? These are linear because this is the area that we are getting it from. So now that they are linear, the circular portion of this is the flow, which helps our mind understand it. This is a low, this low would be linear. This is a low, this low would be linear. So the flow is how would the candle or the line, doesn't matter, the chart, the price, react to this linear experience. So on order flow, you get to see when people actually put orders in and they want to buy it so it can blast off, or they want to sell it so it can come down. But if we don't have access to those numbers in the order flow, I've turned all the order flow stuff in just a circular dome, right? So if we did approach a daily high, this has liquidity, whatever, it has a level, it's above, and it breaks. When we look at it this way, the flow here, a line was created, a low was created. So this could give us that trend line. Once you have 2 points of contact, you can make a trend line. But instead of making a trend line, we're just gonna curve this, right? We might not know that it's right, but that curve, again, stops all of this drawdown and instead makes the drawdown right here, just inside. This is your trend line drawdown, and this is your curve drawdown. So instead of picking this as your entry because of the 2 touches on the trend line, and that's it, that's all you're gonna watch. Now this trend line needs to hold from this low level, as long as it doesn't touch this low. So then if it closes under this trend line, you're gonna get out of your trade. But you're taking way too much risk when you could have just noticed if it breaks this low and this dome, then you're out of the trade, right? So the flow is how does it treat that actual linear structure. So linear should get us thinking about this is where I want to do it, but now what does it look like to give me confidence to do it? So now that we broke out and we get to this daily high, imagine it goes above. Then it retests. This is a break and retest. Normal traders would think linear and they would enter this break and retest. And then it falls through, and then it goes above, then it falls through. They put their stop loss because they're scared if it's not gonna work. It sweeps again, it sweeps again, it retests again. This would be another entry. But all of this is linear. But if you had a circular mindset, you'd wait for 2 points of contact. You'd have another dome to work with. And again, you don't have to have your stop loss moving down here every time or saying the nearest low. You can just keep following the cup in order to actually be involved in this breakout. Now that your stop loss, here's your dome, here's your stop. If you actually break it, you can move your stop. And if it fails this rejection, then at least you get stopped out here and your entry was maybe one of these 2 points of contact. So it's still in profit or a small loss before you actually do get the next drop. That does take out both of those 2 lows that you normally had your linear trendline entries from. So this mindset is truly a winning game about risk management more than it's about trying to get the best entry on the entire day or the entire picture. Because when you want the best entry on the entire picture, you think more about what you'll gain instead of what you'll lose. So if your entry is going to be here and you believe that this would get up here, you're okay with seeing this price go down here because the risk to reward is smaller, right? You can't think like this because then you'll give up too much money that could have served you in a better manner with a different flow, right? So that's like major key takeaway when it comes down to even me and my journey being a trader. You know what I mean? Does that make sense? Yeah.
Perfect sense.
It gives you way more opportunities.
Yeah.
Yeah, because like the big trade, the big picture trade, it could still give you a great trade and lots of profit. Or you could have taken it in 4 trades and doubled your profit.
Yeah. You might squeeze more money out the picture too. Yeah, and then sometimes you just give it too much opportunity to change. And for us as human beings, when we set goals in like a determining mindset, we don't like to change our goal because it makes us feel like we're going back on our word. You know, whether that's a manly thing, whether that's an ambitious human being thing. We just don't like going back on our word. So if I said it's gonna get to this level, it's gotta get to that level. But things changed. So we have to be dynamic and adjust it. You have to be okay with that, you know what I mean? So if this is what you're gonna get, it's better to take the green off than getting stopped out and just saying, well, I stuck to the trading plan, you know? Because now you have ego more than you have an actual like risk management parameter, you know what I mean? So I've learned that as well.